Now, in today's market, finding genuinely valuable stocks at attractive prices feels like trying to discover a needle in a haystack. In 2024, most of the big players, the Apples, Googles, Nvidias, and Amazons, have reached sky-high valuations, with their stock prices hitting all-time highs again and again. These companies have become synonymous with expensive price-to-earnings multiples, making it hard for value investors to find a real deal. But what if I told you there's a whole different playing field, one that's largely been ignored by the crowd? Let's shift our gaze eastward to China, where we see something astonishing. Massive tech giants like Tencent, Alibaba, JD.com, and Baidu have seen their stock prices plummet in recent years. And it's not because these companies are failing. Far from it. In fact, they are more competitively positioned than their US counterparts, which makes the situation a goldmine for value investors. Some of the world's most renowned investors are taking advantage of this opportunity. And if you're serious about making smart investments, you don't want to miss out on understanding why. It all started when the legendary Charlie Munger took a big bait on Alibaba. Soon after, other heavyweights followed in: Monish Prabrai, Guy Spier, Howard Marks, and even the elusive Michael Burry, who rarely holds positions for long, have maintained their stakes in these Chinese giants. So, what is it that they see? Why are these powerhouse companies trading at such dirt cheap valuations? And what risks are investors taking on in this complex market? China presents an interesting scenario. It's one of the largest economies in the world, with a massive population and unique political system that can create both opportunities and obstacles for businesses. On one hand, China's restrictive policies toward foreign tech companies have paved the way for its domestic giants to grow uncontested. Without competition from Western tech, giants like Google and Facebook, companies like Tencent and Alibaba have had the freedom to flourish. Look at Tencent's WeChat. Back in 2012, it had just 15 million users. But fast forward to today, it has ballooned to a staggering 1.3 billion users. These companies aren't just struggling, far from it. According to our research, Tencent pulled in an impressive $26 billion in operating income last year, while Alibaba raked in $18 billion. JD.com saw $4.5 billion and Baidu took home $3 billion. These are incredible profitable business, yet their stock prices remain deeply discounted. So why the disparity? Well, the very same political system that allowed these companies to dominate has also sparked significant concerns among investors. One major risk is the unpredictability of the Chinese Communist Party (CCP), which can wield its influence in ways that may not always align with the interests of the shareholders. A prime example is Alibaba's 2021 antitrust fine, which totaled a staggering 18.2 billion yuan and roughly $2.8 billion. This wasn't a one-off event either. Later that year, Alibaba also committed to a mysterious $15.5 billion donation to the CCP's Common Prosperity Fund, with no clear explanation other than it aligning with the government's broader goals. Tencent followed suit with donations totaling $22.7 billion in the same year. Investors are left wondering if these so-called donations were voluntary or if these companies were in a way compelled to make them. Moreover, foreign investors face another layer of complexity when it comes to owning shares in these Chinese companies. While Alibaba may be a Chinese corporation, foreign investors can't technically own its stock directly. Instead, investors buy shares in an offshore holding company set up in the Cayman Islands, which in turn has a contract with Alibaba's actual businesses. This structure, known as variable interest entity, is completely legal, but it adds a degree of risk as the Chinese government could theoretically crack down on the VIE system at any time, leaving foreign investors high and dry. Then, there is the potential of these companies to be delisted from the US exchanges if geopolitical tensions between the US and China continue to rise. In short, while the opportunity is there, the risk looms large, and that's exactly why these stocks remain so undervalued. The state of the Chinese economy also plays a role, as the CCP has tightened its grip on real estate developers and refrained from large-scale stimulus post-COVID. Chinese consumers have started feeling the pinch, with much of their wealth tied up in property values. Failing home prices have led to reduced consumer spending, which directly impacts the revenue streams of companies like Alibaba and JD.com. This economic strain, coupled with the ongoing political and geopolitical risks, has created a perfect storm that has kept many investors at bay. But for those bold enough to enter the fray, it's an opportunity. The late Charlie Munger and other heavy hitters saw something in these businesses that made them willing to take on these risks. They saw undervalued assets with the potential for significant returns. In an exclusive conversation with Matthew Patterson of Patterson Capital Management, we explored this exact situation in depth. Matthew used Alibaba as a prime example of how these political risks have created a rare valuable opportunity. According to him, Alibaba is one of the most undervalued large-cap companies in the world, and over the next decade, it's poised to maintain its dominance in the tech space. Here's where things get really interesting. Alibaba, valued at nearly $200 billion, has a cash reserve of $50 billion, buys back shares aggressively, and generates $25 billion in EBITDA annually. Over the next 6 years, it's expected to generate enough cash to match its entire enterprise value, which is a staggering proposition for value investors. Think about it. A company of this magnitude practically giving itself back to its shareholders in cash over such a short period. When we break down the numbers, you will see that Matt was trying to get us something special. The enterprise value of Alibaba sits at $182 billion with an EBITDA of $24 billion, giving it a multiple of just 7.5 times. That's an incredible bargain by any stretch, especially for a business of this size and profitability. For value investors, this is the definition of opportunity. Now, Alibaba isn't the only player in this game. JD.com, another giant in Chinese e-commerce, has an enterprise value of $32 billion and generates $4.9 billion in free cash flow, giving it a multiple of 6.7 times. Baidu, with an enterprise value of $23 billion, is producing $4 billion in free cash flow, a multiple of 5.8. Across the board, these companies are cash machines trading at rock bottom prices. And as Matt pointed out, these businesses are using their excess cash to buy back huge amounts of their own stock, a clear sign that they believe they are severely undervalued. But while many see those low valuations as buying opportunities, others, like Warren Buffett, are more cautious despite Munger's confidence. Buffett chose to stay away from the Chinese market, and that's really what this comes down to, balancing risk and reward. It's not a question of whether these companies are cheap, it's whether you believe the risk is worth the potential reward. So, what's your take? Are you willing to embrace the risks for a shot? Are you willing to embrace the risks for a shot at these deeply discounted tech giants, or is the uncertainty too much for you to bear? Let me know your thoughts in the comments below. Thanks for watching, and I'll catch you in the next one.